All right, we'll get started now. Welcome to another webinar from Centaura, formerly Into the Block. I believe in the last webinar, our now Chief Product Officer and CTO, Jesus, made the announcement that we had completed a merger between Into the Block and Trident to create the new company Centaura. So continuing the same webinar style and series, but just under a new name and logo. So my name is Gabriel. I am part of the research team at Centaura, and today we're going to be talking about restaking and with a focus on a paradigm shift in restaking, how it was previously visioned, what it's looking like now, and what does that mean for risk and rewards in DeFi. So to highlight real quickly, we'll always start as we do with a couple quick updates from our side. Then we're going to do a very brief overview of restaking. For those who follow this regularly, you probably remember that I have already done a couple different restaking webinars in the past. So I don't want to go over content again and again. So we'll just highlight this quick for anybody who's coming to the restaking world to give them a little bit of a rundown of how it's going. We're going to look at how risks are changing and what that means for restaking and restaking platforms in general. Then I think a good question that maybe some people would be asking themselves is, has this whole restaking narrative, restaking design, is it working? We'll highlight this, dive into a couple different aspects, if it's working or not. And then what I'm just going to be calling restaking 2.0, as we see some changes in the structures of the different existing platforms, and then also what the core focus is of these, and how that might change the restaking narrative and ecosystem for the future, and then finish with a conclusion. So to start, a couple quick updates. First, we announced this just yesterday, our what we call CoinDesk overnight rates. So this is a product that our, let's say, traditional finance team has been working for over a year to develop, essentially a overnight rate equivalent of DeFi borrow rates for stable coins. Specifically, we're looking at Aave, USDT, and USDC rates to create an index for the cost of these over time on a daily basis. What this is going to be essentially doing is it's going to act as the cornerstone product to be able to build futures on top of this CDOR product, which is going to allow people to make hedges on borrow rates for stablecoins in Aave or in DeFi in general. So it's a pretty big product launch. I'm very excited to see how this works. Me coming from a very DeFi native side, these are some things that are, let's say, more novel to me, but definitely is part of Centaura's larger vision of bringing institutions to DeFi. Having these types of products can really help enable larger institutions to make certain hedges that will make them more active participants in DeFi. So very interesting product. Patrick from our team was the one who had been building this. So congrats to everybody who had been working on this. We'll see how it comes in the future. I think we should be seeing the futures contracts coming out in the next couple months. And then on the risk side, the risk radar, we have launched a new indicator for all of our lending markets, which is whale activity. So we have had some whale metrics that are still there in the each of the different lending market dashboards. But this one is looking specifically at just any large transactions that are happening on any of these different protocols. So this not only is looking at like large liquidations, but it's looking at mints and redeems. And you can track and see the whale addresses that are performing these, which is really helpful to identify trends and how certain whales are behaving in the market. One that we have talked about in our risk newsletter and on social media before is the USDT whale on Aave that very regularly is withdrawing or depositing, 500 to $1 billion, 500 million to $1 billion USDT all at once. So they have large influence over rates in the USDT market. Using this metric, you can track and see how their patterns of activity are, which can maybe help you in your DeFi strategies. Now moving into the nitty gritty, we'll start with restaking overview, which we'll start with, what is restaking in its current form? It's pretty basic at its core. It's just essentially extending classic staking. So that is, staking your ETH to the beacon chain to perform tasks to secure the chain and receive yields. So taking this classic staking and essentially extending that so those staked assets can secure additional services. So additional protocols or some sort of secured service on top of it, where this staked ETH is not only performing its core duty, securing the blockchain, but it also can help secure these additional products that are built on top for additional fees and yield. So this, at its core, was to use the same validator sets that are seen in staking traditionally, and build on top of that to provide security for more services, more products on the Ethereum blockchain for additional yields. And a quick overview on how this works is essentially you either have your base ETH that you stake directly into EigenLayer, which will then restake and stake all of that at once, or you were taking like a liquid staking token and staking that into EigenLayer. And so essentially what it is doing now is it's performing two tasks, as you can see here with this split where you see the ETH token. It's performing the consensus and execution of the blockchain, but then also it is performing additional services to the AVSs from the EigenLayer standpoint, which all can then be fed into DeFi apps that people are using on a day-to-day basis. So this is allowing you to earn additional yields, as we said, from the on top of the base layer. And it is allowing this kind of very monolithic staking to become more diverse and flexible, being able to provide security for multiple services. And who are the core market participants? So really, who are the people supplying and who are the people buying this staked ETH? So the suppliers are stakers. That's either retail or institutions who are looking to earn additional yields on top of their regular staking. And so that's you and me, or some centralized exchange. They're supplying this ETH to get these additional rewards. The consumers, on the other hand, these are different services, protocols, products that are looking to purchase or rent security kind of on an on-demand basis from these suppliers. So this can be app chains, L2s, even L1s, oracles like agents and AI agents and their infrastructure, bridges, etc. The list goes on and on of different services that maybe are wanting to use the security of the staked ETH to perform transactions. And if one of those transactions goes wrong, then the ETH that has been restaked gets slashed in this example. And so why would you restake? For stakers, I think it's quite simple. You're looking to get higher yields without having to unstake your base ETH. For consumers or the AVSs, the protocols, the services that are getting this security, it's a great way to scale and bootstrap your security immediately. It reduces a lot of like execution overhead from their side because they just tap into this existing marketplace without having to set up all these different validators and the education and onboarding that goes on with that. And ETH as an asset is already a very large economic security base. And so you're able to tap into this much easier than, bootstrapping security from your own token, which is often the alternative for L1s or L2s, maybe that are trying to go with some different token as a security measure. So as an example here in this screenshot from DeFi Llama, you can see for wrapped ETH from EtherFi, which is an LRT, you can see that there is 0.5% higher yields than just STETH from Lido. So this is what stakers are searching for. That's why we've seen a large demand in the product so far. And then kind of a circuitous roots of what has happened with restaking in general. It started off just as ETH. And the nomenclature of restaking was really a way to kind of define this staked ETH that is performing additional security tasks again. So in a sense, it's restaked. But now a lot of platforms, if not all platforms, have pivoted to not just accepting staked ETH, but also other assets that have never been staked before. So you can see it's a bit small on the screenshot here, but you can see in EigenLayer, there's some Pepe, there is the Renzo governance token, there's Redstone, the Oracle token. These are all being staked in EigenLayer. So these don't have a native staking component like ETH does. And so they're not technically restaked, they're just being staked the first time. But now they're all in the same platform, which has been called restaking. I think we should, start to think of it more as just like staking or security staking. There hasn't been a new term that's been coined yet. So if anybody has one out there, please let me know, because it would be nice to kind of maybe move away from this restaking terminology, because I think it's been quite confusing for a lot of people. But for now, I'll just do it with restaking with the parentheses around the res, and some of it is just pure staking, and that's how I'll move forward in this webinar. The thing with restaking, though, in general, is that it has been a major redefining aspect for DeFi with these boosted yields off of whatever the underlying or the first order derivative product like wrap staked ETH is. That boost of yield has become quite popular in many DeFi strategies and has really taken the DeFi market by storm, not just for LRTs on ETH, but we also see it with the different LSTs on Bitcoin. So we're talking about Lombard and Babylon, for example. And I think a perfect snapshot of how quickly the popularity of LRTs and the restaking assets have captured mindshare and market share in the DeFi space is looking at the collateral distribution for wrapped ETH on Aave's market on Ethereum, where we can see that over just a bit over a year, wrapped ETH has become the dominant collateral being used to borrow ETH. So this is for people that are doing what is called leverage restaking as a strategy to boost their yields. Surpassing the 2 billion at a high of wrapped staked ETH that was being used as collateral very quickly, and is now near 4 billion, just above 4 billion. Uh, Collateral being used for restaking or for borrowing ETH. So that can show you that it's kind of 4x the size of the Ethereum market in current day rates. So pretty impressive how quickly it has captured a lot of the economic activity on DeFi. Now, after that quick overview of just what restaking is, let's look at some of the evolving risks because there's been a bit of a slowdown in developments in the restaking world, and I think this has been in part due to the risks that are trying to be addressed, plus some other parts that we'll talk about later on. But the first thing is that restaking in general diversifies risks. So I made this chart just really quickly to kind of emphasize how it diversifies risks. So we're looking at the different assets. Either the pink ones are liquid staking tokens, the blue ones are liquid restaking tokens for Ethereum. And essentially we're looking at how many different services they're securing. So for liquid staking tokens, they're all securing the same thing. They're just securing the Ethereum blockchain. For liquid restaking tokens, all of the different AVSs are additional layers of services that these liquid restaking tokens are securing. And so with each of these different AVSs that the liquid restaking token is securing, it adds a new layer of risk and risk management that needs to be involved. And as you can see from all the blue dots, it varies quite a bit on how many AVSs are being secured by each of these different assets. So, some might be closer to like 10 AVSs, some might be up around 20. And so this means that where liquid staking was very homogeneous in the risk profile it presented, restaking is very heterogeneous. So each of these AVSs has its own risk profile. The more AVSs you add into a liquid restaking token, changes the dynamics of the risk profile of that asset and what its slashing risks are, what its rewards are. And so this is very much and very quickly changing how we need to perceive the risks when we are entering one of these assets to hold or use in DeFi. And additionally, this is kind of outside of restaking narrative in general, but there has been what I think are some shifts in the risks that are most prevalent in DeFi. So pure technical risks like smart contract exploits appear to be trending down as security strengthens. Now, the caveat to this is that operational security risks are definitely on the rise. So operational security risks, I throw all of the like social engineering exploits that have recently happened, like the Bybit one, for example, and some of the other large exploits that have happened recently, into this operational security risk side. It's not the contract, the smart contract itself that's being exploited. It's usually key management, someone's either computer server being exploited and some malware being injected through that. What is on the rise is economic security needs. So as we see, as more and more AVSs are being stacked onto one of these different LRTs, each of them have different like economic components where slashing, each of these AVSs has different slashing mechanisms. And so as you add more and more of these, you have a more complex economic security environment that you need to manage. Not only just on the LRT side, all of the real world assets that are coming on board add new risk profiles that are not native to DeFi itself. So, some of these different credit products that are coming on that are tokenized versions of some traditional finance asset vehicle. These have different liquidity risks. They have different risks that are coming from TradFi that are going to further complicate how economic security is being managed on DeFi itself, because you're not necessarily going to just as easily be able to take one of these real world asset tokens and trade it in the market, or if a liquidation happens, that will be able to be liquidated quickly and be redeemed for USDC, USDT, or even fiat. There might be some sort of unstaking, unbonding periods, or low liquidity in traditional finance where you need to realize this trade. And these all increase economic security needs in DeFi. Restaking really helps the most on technical economic and pure economic risks. So pure economic risks are the ones I was just mentioning. Technical economic risks are what I call securing the blockchain. So making sure to prevent any sort of 51% plus attack, things that would normally be done with the core asset of a blockchain, for example, but these can be replaced with restaking in many ways. So these types of economic risks are where restaking performs best. But the question is it working? The short answer is no, not yet. The supply is there. There's about 20 billion TVL across staking platforms. Symbiotic, Eigenlayer, Babylon. Builders are there. There are several AVSs that are launched that are starting to set out products, but there just hasn't been a functional marketplace connection, and so we aren't seeing the circle get fully closed yet. I don't think it's never going to happen, but there are definitely some frictions in the last 10% that we're still waiting to see get figured out. What are some of the causes for why it's not working yet? I think there's definitely narrative fatigue. Now, restaking has been talked about quite a lot for a year and a half at least. Excuse me. I think this can really be highlighted from Symbiotic, which really they've been one of the quickest movers in the restaking marketplace, and this is no fault of their own, but we can see, for example, they had free deposit vaults before the full feature protocol went live, and those vaults needed to be migrated to new vaults, the TVL, to actually be part of the actively slashed network being utilized for restaking. And we can see here that there's still hundreds of millions of dollars of TVL that are sitting in these pre-deposit vaults that haven't moved over to these active vaults. So nothing's happening on this underlying assets here. They aren't getting any sort of like points or like additional rewards from services. They're just sitting there and they haven't migrated. So from my standpoint, this is showing fatigue. People are not seeing the narrative play out. And so they're just waiting to see what happens. They're fine with earning whatever the wrap stake DETH rate is, and they'll just leave it as that. Also on Eigenlayer, you can see slashing has been live on Eigenlayer for about 2 months now, and none of the ETH that is allocated to these different AVSs has actually been set to be slashable. So this means that the whole slashing aspect even though it's been live, is not being used. So this is showing some sort of disconnect that um, something is happening in this less 10%, as I said, where the certain market dynamics or mechanisms are not well suited for the marketplace that the marketplace needs. One of these, I think, is slashing designs. So like most of this was built off the idea of a slash and burn mechanism, which can work, but doesn't fit every use case. I think there will be some other slash designs that we'll talk about in a little bit that will be quite that will open up a lot more use cases and products once they start being adopted. Also, possibly the thesis of selling technical economic security is wrong. Cosmos and their interchain security has struggled, where the Atom token was supposed to secure multiple other blockchains. There has been some adoption, but not a lot. It hasn't really taken off. And we see the same thing with restaking, with Babylon, Eigenlayer, Symbiotic. These L1s or L2s that are wanting like this technical economic security for any sort of objective, verifiable on-chain economic attacks that can be managed through restaking with slash and burn. Maybe there just isn't a lot of demand for this as one would think. So moving to what restaking is going to look like in the future. I think one of the big ones is going to be adapting to market needs. And the main thing here is transitioning to target broader economic security. So this is, think of it as economic security as a form of insurance for on-chain actions, where maybe there is more at stake to be slashed, but this is going to be some way where the stakers are securing actions. If those actions go awry, then their money gets used to pay out to the affected victims of the malicious attacker or whatever it might be. So a trend away from like purely objective tasks, as I said in the previous slide, and then embracing an array of new slash designs. So slash and burn, but as I was just saying a second ago, slash and redistribute. So the idea, which you can see in the bottom image here from Symbiotic, the idea is that if there's a slash that happens, it goes to compensate the users that were affected by whatever the malevolent transaction or attack was. And so this redistribute aspect is going to allow for people to become whole if some attack happens, and this will open up a lot of use cases. That being said, you always have to be very aware that any of these slash designs that change, and it's not just a pure slash and burn, but someone is kind of in quote unquote getting rewarded for the slash to happen. You need to be aware of any sort of incentive misalignments among the different actors and try and manage the slash design accordingly. Isolated designs, I think, are going to be something that is quite successful. So some, like if you think of Symbiotic, they have these different vaults. Each of these vaults can be associated with several secured networks. And so with these, you're able to create a much broader spectrum of risk and reward designs based on each of the vaults. So each of the vaults will be isolated for any sort of slashing that is happening to that vault. It's not going to be at the protocol level, but then you can have higher risk level stuff that has higher returns, or lower risk level stuff with lower returns, which will allow users to have more choice to align with their risk reward profile. I think that this design is going to be quite successful moving forward. And then I think there's going to be, just in general, this is a brief overview, but just in general, a large shift in how some of the mechanisms in these platforms and protocols are designed. So one thing that we're seeing right now is it seems like these isolated vaults, these security vaults, are going to start to converge on the feel of DeFi vaults that we see at the moment. So DeFi vaults, I'm talking about like liquid vaults from EtherFi, the Lombard vaults, uh, the vaults that you see that are proposed by Veda for different DeFi ecosystems that we manage as well. You're going to start to see that these security vaults and these DeFi vaults are going to become very similar in how they look, where uh, different strategies or different services are going to be secured by the vault. But the vault curator is going to have probably a larger role in the management or in the design and actions of the vault. And it brings up the question is how will the operator roles evolve? So we didn't touch on it in this presentation, but the initial design was that you would have the stakers, you would have the AVSs if we're talking about eigenlayer, and then we have the operators that are kind of in the middle, connecting both the AVSs and the stakers. And so they're the ones performing the tasks that the AVSs need. And if the operator doesn't perform a task correctly or tries to do something malicious, then they get slashed by the AVS, and that slashes the staking assets of the stakers. So it's possible that we're going to start to see like operators start to take on a different role. So for example, there is a protocol coming out, a stablecoin called CAP, that looks to tap into some security from EigenLayer and other restaking networks, where the operator will actually be running strategies. So this is coming back to the first point here, where we're going to see this kind of convergence on DeFi vaults and security vaults. Essentially, this one is the operator is going to be running the strategies that you would normally see in a DeFi vault, but getting security, which will be collateral for a loan for them from the restakers. So as you can see, this Venn diagram starts to become almost a circle on top of a circle here, where you're going to see a lot of different designs that are going to be looking much more like just kind of insurance in DeFi for different tasks being done than for some sort of like staking proof of stake network design that you were initially seeing for EigenLayer when they initially launched. So in conclusion, current restaking design has seen difficulties in adoption. That one is, I think, quite clear. The design trends that are happening are probably going to make it a lot more accessible to new product types, which will be good for the entire market. Broader economic security is going to more closely reflects insurance is going to be the thing that I think pushes a lot of these restaking platforms into the level of success that they're hoping for, which is going to be a different design what they initially thought, but still is something that DeFi wants and needs. Isolated security vaults will I think grow and become more successful as this broader economic security aspect is adopted more, and the definitions for the different participants is going to be changing over time. So as I said, operators, I don't know if there are even going to be operators for some of these security vaults. There might not be the need for them. Maybe they'll be performing different roles. There might be more need for risk committees where you have like trusted entities that are performing the like slash confirmations. the operators are just performing like data retrieval for them for different off-chain data. And as the increase in Slash designs expand, use cases will also expand, but the different mechanisms are going to have different risk profiles. So that's the webinar for today. Monday, June 23rd, tune in to Centaura's first X Spaces. It's going to have our CEO, Anthony, and our CTO, Jesus, on it, talking about institutions and DeFi. And then also sign up for our next webinar, which is going to be exploring DeFi prediction markets. That is on July 16th. Thank you for attending. Let me know if you have any questions.